Hi friends, if you're confused and worried about your portfolios because of the ongoing war between US, Israel and Iran on the other side, then this video will massively help you because in this video I'm going to speak about 4 key aspects. Number 1 is that is there likely to be a global equity market meltdown or a crash because of what's going on? I'll try and give you my perspective on that. Number 2 is impact on Indian stock market. We're going to look at broader indices. We're going to look at few sectors. We're going to talk about what have been the case in the past. I'll give you some data backed analysis on that so that you understand what strategies can you really deploy onto your portfolio so that your portfolio is protected as much as possible in these volatile times. Number 3 is the impact on US market as well. We're going to look at few things around US stock market. And finally, we're going to talk about gold as an asset class as well because of what's going on. It's an important video. Please watch it without skipping. You're going to learn a few new things hopefully, and I'm going to present to you a lot of data, so bear with me. And also, if you're new to my channel and don't know me, my name is Rahul Jain. I'm a SEBI registered research analyst. Welcome to my channel. If you also want to get premium content, you can join my YouTube community. I post almost on a daily basis, not every day, but almost on daily basis, exclusive content for my members. These are not buy, sell stock recommendations. These are insights. These are point of views that will help you get perspective and insights about the markets. With that, let's get this video cracking. So let's start with first point, which is, can global equity markets actually collapse, or can there be a bigger market correction or a crash that might be coming up our ways? Now, this could potentially happen if this current ongoing war shapes into something like a World War III situation, okay, where a lot of countries join into this war. And in that case, yes, there is a possibility. You cannot really rule out that the global equity markets will not collapse. Now, whether the World War III situation will arise or not, I don't know. I'm not an astrologer here, but I was reading this article here, and apparently this lady from Bulgaria, she's a blind Bulgarian lady, and she had made a prophecy that in 2026, there is likely to be a global war situation, which anyways is playing out right now. And she said that this war could continue for around 7 months. Again, please don't get me wrong. I do not believe in prophecies and predictions like this, but I'm just sort of sharing what is going around on internet so that you at least understand what are people talking about. Another important point is that recently Russia said that there is possibility of World War III if these attacks continue, and they are giving some threats and warnings. So almost each and every country is now starting to make some comments about what is going on, and there might be a situation where countries start to take the sides of each other, and it might not be a good side to look at, right? On the top of it, if you look at people like Robert Kiyosaki, he is saying that the biggest crash in the history is coming. Guys, these are all speculations. Nobody really knows what's going to happen. But one of the important factor for us to understand is that right now the world is going through a lot of uncertainty. Okay, global equity markets are reacting very, very negatively to what is going on. For example, if I talk about the global equity market and show you some data, look at United Arab Emirates, UAE, 4.87% down, Thailand, Chile, Kuwait, Greece, Colombia, Philippines, Germany, Qatar, Sweden, a lot of countries, broad indices, okay, these are broad indices at a country level, something like Nifty in India, they are responding to all of these war conditions by around 2 to 5% of average fall already. Okay, and we are on almost like day 3 or day 4. I don't know when you're watching this video. So it really depends on what is lying ahead in front of us, because these indices might fall further. I'm going to talk about India's specific impact in a minute, but first you understand why global equity markets are panicking right now, right? Because it's not only one country, it's a global phenomena. Although US right now has relatively not given this sharper a correction as of now, but I'll come to US in a minute. But let's first understand why global markets are sharply reacting right now. One of the major concern is right now, of course, war is sentimentally bad for equity markets. But more than that, Strait of Hormuz, which is controlled by Iran, all of us know about this, almost 20% of oil of the world goes through this particular passage. And it's a very, very narrow passage, which is controlled by Iran. You can see on my screen the data as well, around like 20 million barrels per day of crude oil, petroleum products are going through this particular passage. And very, very recently, Iran has given a warning that any ship that goes through this Hormuz, then they are going to put that on fire, right? And of course, when this sort of warning is coming up, no ship is going through that, and it's for all practical purposes closed. Now, this has a huge impact on equity markets. Why? See, number one point is that the oil prices are going up because of this. And there is a speculation that what happens if the crude oil hits around $100 a barrel, which is likely to be a very, very high prices when it comes to oil. And this is not just about oil prices. If you look at the gases as well, so LNG, for example, so since now Qatar had halted the operations, if you look at the European gas, and if you look at the Asian LNG, which is the liquid natural gas, these prices are also going up. So there is sort of energy crisis happening right now because of these war situations. And when the energy prices go up, be it the oil or LNG or whatever, typically what happens is that your inflation goes higher. Why? Because every product start to become costlier. A lot of things are run because of the oil and natural gas, and things start to get costlier. Inflation goes up. And when inflation goes up, the interest rates, if you look at the central banks, they're not going to cut them. They might increase them. And when the interest rate goes up, what happens typically? Generally, stock markets do not like that because the borrowings become costly. Businesses start slowing down. They don't want to push more money into the businesses because the interest costs are very, very high. And therefore, the equity markets start to bake all of that, up front, and they are not even waiting for it. The stock markets start to fall and collapse. Now, how deep these corrections could be, it really depends on how long this war stretches. Longer the war stretches, the longer this Strait of Hormuz remain closed, longer the equity market are not likely to get up. They might go into bearish territory as well. There might be a sharper fall across the markets. But let me come back to Indian stock market and what it really means to our portfolios, because I think a lot of us are heavily invested in the Indian stock market, either through mutual funds, ETFs or direct stocks, right? Now, if we take a step back and go back to 2003, right, something similar happened where US and along with many other countries like UK invaded Iraq. It happened in March 2003. And at that time, if I show you what happens to the Indian stock market, so if you look at my data between January 2003 to almost April 2003, market was really contracting. And if you see around 16% fall in Nifty. At the time, Nifty used to trade at around 1,923 sort of a level. I used to be in college at that time. Point I wanted you to be aware is that in these war situations, Nifty will fall. It has fallen by around 16% in the times of 2003, right? The current level of Nifty is around 24,800 when I'm recording this video. Could it fall further? Absolutely. You cannot really rule out the possibility of 10% fall from here. It is absolutely possible. But my point is that if you are worried about your portfolio, if you are really worried about your mutual funds or ETFs, please understand that these falls are very, very temporary, right? Nifty is 25 times from where it was in 2003, and the war is very, very similar. In fact, the Iraq war dragged for a lot of years. Okay, again, every war is very, very different, and I'm not going to say that it's going to be exactly what happened in Iraq war. No, absolutely not. I'm not trying to tell you. All I'm trying to tell you is that equity markets react very, very sharply whenever these situations happen. But if you're a long-term investor, you should not panic at all. In fact, let me show you some more data so that you understand the gravity of this situation. Have a look at last almost, I would say 46 years of data, 45 years of data. Almost every single year, Sensex has fallen by on an average 10 to 20%, right? For example, if you look at 2008, it fell down by almost 60%, right? But if you look at the last 5 years since COVID 2020, the falls have been limited around 10%, 16%, 7%, 10%, 9%. These are intra-year fall. Okay, the maximum drawdown in a year. And at the same time, have a look at where Sensex actually ends up closing by the end of the year. So for example, here, look at 2020, right? Minus 38% drawdown because of the COVID, but actually the market closed by around 16% positive. Even last year, if you look at intra-year, it was down by minus 9%. But if you look at the closing, Nifty gained by around 9%. So somebody who got this at around minus 9%, by the end of the year, they were sitting at 18% profits, right? Minus 9 plus 9. Point is very, very simple that these are the times where the buying makes a lot of sense, right? In my view, if you are a long-term investor. If you are a trader, if you're doing FNO, you have all the reasons to really worry about. But if you have a long-term horizon and if this volatility does not really bother you, then you shouldn't really worry about anything. I keep telling this on my YouTube community as well that, these are volatile conditions. They are likely to be there, but the big money is made only when you're buying when the markets are falling. right? Because you sit tight for long term, mid to long term, even 3 to 5 years, if not, let's say 10 year, 20 years sort of a time horizon, you're likely to see markets going up. Why? Because nominal growth of India is around 12%, 11%, depending on when you are looking at the year, which year you're looking at. And the stock market has been following our nominal growth rate. There is no question about it, right? So don't worry about it at all if you are worrying right now from an Indian stock market portfolio perspective. Now the question is that, Rahul, can Nifty fall from here, let's say 10%, 15%, 20%, 30%? Could it go down to that level? I personally don't think Nifty can fall by more than, let's say, 10%. I mean, 10% is always a possibility. But why do I say, in my view, that Nifty may not fall more than like 10%? The reason is very simple. If I talk about the last 5 years of data, let's focus from 2020 onwards, right? 2020 to 2025, the maximum fall we have seen in 2020, of course, that was COVID, 38%. But if you look at intra-year, so these are intra-year falls, right? 2022, around 16%. Now, why is the case that in the last 5 years, markets have not fallen, let's say, intra-year by, let's say, 20%? I mean, if I just remove the COVID, and if you go back to, let's say, 2014, you wouldn't see market falling intra-year by around 20%. Why is the case? Because of the SIP flows. So see, in 2020, the SIPs were around 1 lakh crores. If you look at FY 25-26, it's gone almost 3 times, 2,87,000 crores. And SIPs are not getting stopped. If you look at January 2026 data, 31,000 crores of SIPs, still rock solid SIPs. And if you're a SIP investor and you're thinking last 2 years, no returns from SIP perspective, don't worry. These are market conditions. Equity market will never give you like a linear return that every year you're getting 8%, 10%, 12%. It doesn't happen, right? These are good times because markets are consolidating, markets are falling. If you do SIPs, you get more units allocated to you, right? But people don't understand it. People only look at short term. They get worried about it, right? You have to look at mid to long term. 3 to 5 years is the minimum time duration if you are an equity investor. Otherwise, don't invest in equities, right? So from a market perspective, I really don't think Nifty should be really falling below like 15%, 20%. I really don't think that is likely to happen. 10% possibility cannot be ruled out. But let me now give you some deep analysis around broader indices like Nifty, mid cap, small cap. Let's talk about valuations. Let's understand valuations and let's see if there are any opportunities here. Now, if you look at my screen, you will see that Nifty's PE ratio currently is around 21.8, right? Now, is this higher? Is this lower? So if you look at the 5-year average, around 23.09. So from a 5-year average perspective, it is quite low. So it's not that the valuations are stretched. But if I talk about the last 5 years history of PE ratio, so what you see is the green line here, okay? This is the PE ratio. And if you go back to the last 5 years PE trend, what do you note here? Okay, it went down to around 20 here, right? Around 19.96. Then again here it was around 20.40. If you see here as well, March 2023 around 20.21. Point is very, very simple that Nifty's PE ratio at around 20 has been seldomly broken. There was only once here in July 2022, I think. This is where it went around 18.99, basically 19, right? So if I say that, let's say Nifty corrects, okay, and market sees PE at around 20 is, attractive in terms of valuation. So 20 PE is what? So the EPS of Nifty, if I talk about the earnings per share here, so let's have a look at that. It's at around 1142, right? Let's make it 1150. So 1150 into 20, it comes to around what? 23,000. So 23,000 Nifty at that level is almost PE ratio of 20. So could Nifty fall from the current level of 24,800 to let's say 23,000? It is, you cannot really rule that out, but please understand that in the last 5 years, Nifty hasn't really dropped from a PE perspective below 20. So I think there is a good comfort, but what happens if Nifty goes to let's say 24,000, 23,500? In my view, these are good attractive valuations for investors. If you have the risk appetite, if you can withstand the volatility, these are good attractive valuations in my view if you're a long-term investor. What about the mid cap? Let me talk about the mid cap here very, very quickly. Mid cap PE ratio is at around 32. It's well below 5 average, almost 5-year average has been around 32.09. So it's sort of fairly trading from that perspective. If I talk about the last few years of PE ratio here, right? So the pink line here is the PE ratio. And if you look at the PE ratio currently at 32 and at around 32, it's taken good support here, right? Back in April 2025. If you go back to let's say 2024, from that perspective, yes, it is slightly elevated, right? If you look at the PE ratio at that time, around 24, right? So there is definitely room for mid caps to get corrected. I'm not saying it will get corrected. I'm saying there is a scope from a valuations perspective. If I talk about the small cap index, so let me go to small cap here, small cap 250. Here the PE ratio is around 25. This is much more attractive as compared to mid cap from a valuation perspective, right? Because 5-year average has been around 27.80. It's trading much below that. And of course, if I talk about the last few years here, again, the pink line here is the PE ratio. If you see currently, it is at around 25.63. Prior to that, around March 2025, 26.23, good support there. If you go back here as well, around let's say June 2024, 26, good support level, right? Prior to that, of course, prior to the small cap bull run, which was, let's say, if you go back to March 2023, it fell to around 17. So there is a scope for correction for small cap from a valuation perspective, but those will be very, very attractive valuations in my view, if at all small caps correct further. Of course, at the time of recording this video, small cap index is down by almost 17% from its top. Okay, if I remember my data correctly. So, I mean, it's really your call. Broader indices, I see a lot of valuation comfort already. And if there is any sharper correction right now in any of the indices, then to me, valuations become even more attractive. And if you're a conservative investor, then Nifty 50 is slightly better index for you. If you're an aggressive investor, can withstand the volatility, then small cap any days is a very, very good index in my view. Again, not a recommendation that you go and invest, but at least from a valuation perspective, you understand the game here. Now, let me quickly talk about the sectors as well. Which sectors there is likely to be limited impact, higher impact, positive impact. Allow me 1 minute of time. Now, in terms of the sectors that are likely to see limited impact in my view, right? Number 1 is banking. Number 2 is auto. Number 3 is real estate. Because these 3 sectors are primarily driven by our Indian consumption. Why there could be still a limited negative impact on these sectors if you hold any stocks? It is potentially because of sentimental, right? Sentimental fear is there, of course, because of the war situations, people book their profits. That is very, very natural. And the second important point is the inflation fears because of the oil prices going up. If there is a pressure on the inflation goes up, then there are chances that banking, auto, real estate might negatively get impacted. But in my view, the impact is likely to be very, very limited. In fact, real estate is already very, very down. If you go and have a look at Nifty real estate index, I mean, go and have a look at the data. Let me not speculate there. Okay. So in my view, these 3 sectors are good. They have a good story. And if I see any good opportunities in these 3 sectors, I'm likely to bet. It's as simple as that, right? When it comes to sectors that might have higher negative impact, for example, aviation's likely to be hit very, very hard. Global flights are getting cancelled. Their oil prices go up. Their input cost is likely to go up. It's a no-brainer that we need to avoid aviation in my view. Next one is hotels and tourism. Self-explanatory. Ports and logistics, again self-explanatory. Paints, because oil is an input to paints industry. Rice and tea exports. So India exports a lot of rice to Middle East countries. In fact, I think 25% of our rice gets to Iran. So huge problem there. Tea exports as well to a lot of Middle Eastern countries. So those FMCG companies or those food companies are likely to see huge impact if the war gets stretched really, really long. I don't know how long it will continue. Oil marketing companies, we're already seeing some hit here. They are likely to be a big no to me, right? Because of what's going to happen, the uncertainty is there. Positively, sectors, couple of them, defense, of course, it's going to rally. And I don't think defense is a good spot right now. Sectors like defense, we need to look at those when there are peace, because at that time the valuations are cheaper. Right now they are going to all rally, or they've already rallied a lot, right? So we need to be really careful. And then you have oil producing companies that are likely to see some benefits. But all in all, if you ask me right now, going for individual stocks is much riskier as compared to, let's say, ETFs or mutual funds, because I personally find a lot of comfort in terms of valuations on broader indices. So again, it's your call depending on what you want to do. But one of the golden rules that you need to follow right now is that do not do any panic selling. Okay. Your portfolio, if it is down by 10%, 15%, 20%, I do not know the number, right? If it is down, please understand that it's a volatility that you're seeing in your portfolio. It's not the actual loss. The loss is a loss when you actually book the losses, right? Unless you sell, there is no loss. It's all there on the P&L that you see, but actually, is it a loss? No, because when the markets recover, whenever that happens, if you're a long-term investor, then that loss is not there for you. But a lot of people just see the P&L and their daily portfolio and get worried. So panic sell, in my view, is a big no. Let's now move to US stock market and have a look at what's going on there, right? So at index level, be it S&P 500 or NASDAQ 100, there is so far limited impact, right? But if you look at some of the tech stocks, in fact, there has been a quiet selling happening in tech stocks. For example, have a look at, let's say, Microsoft. Last 3 months, it's down by almost 19%. Palantir, 17.24%. Accenture, 15%, right? Netflix down by 9.33%. Amazon, 8.36%. Tesla down by 5.64%. Google, not so much, 2.56% in last 3 months. Overall, if you see, a lot of tech stocks have already started correcting in the last 3 months. This is been happening there, right? Now, could there be further correction here? It is entirely possible here that the profit booking might kick in, right? It also depends on individual stocks, right? Could that be the buying opportunity? I think if you want to play AI theme, you really have to decide whether you want to go in for AI or not. So far, I've been sitting on the sidelines, which is fine for me because I don't know what's going to happen in the next few months in terms of the war uncertainty as well as the stretched valuations, which is always the case in AI themes. So again, up to you really what you want to do with the AI stocks. But when it comes to US stock market, I've been doing a very simple strategy of following a triple Q ETF, which tracks NASDAQ 100 as an index. And I've been doing some sort of weekly SIPs in there because if the market corrects, I'm fine. If the market doesn't correct, then also I'm fine. These are long-term SIPs that I started doing. And important point that you need to know is that you also need to understand how the US markets really work. What's the implication of concepts like TCS, which is the tax collected at source? Very recently, I wrote a detailed post on my community talking about the TCS, which is the tax collected at source, right? One of the important points is that if you want to invest in US stock market, up to 10 lakhs, you don't need to pay any tax if you're transferring that money outside. But if you cross 10 lakhs, more than 10 lakhs, then of course you have to pay 20% tax, right, on that amount that you exceed. Of course, you can claim it back, but these are the nuances that you need to understand. I've been constantly talking about some of these important, concepts about US investing. If you want to learn any of those ideas, then you can join my YouTube community. I almost on a daily basis, I'm speaking about a lot of asset classes there, making you more educated rather than giving you buy or sell calls, right? That's not what the community is for, right? But coming back to US stock market, my simple strategy remains that I continue with my SIPs in NASDAQ 100 based ETFs. That to me is fine. If there is a huge correction, then definitely I would look to buy some lump sum as well, right? If there is not huge correction, if it's almost sideways, I continue to do SIP for my long-term investments. That's on the US stock market. Again, I'm not going to go into a lot of details. If you have any specific questions around US stock market or any specific US stocks, let me know in the comments. I might do a part 2 around US investing and you might get your questions answered. With that, let's move to asset class number 3, which is gold. My last point that I want to quickly speak about. Now, before I speak about gold, if you have any other questions around Indian stock market, specific sectors or indices, let me know in the comments. I'll try and answer as many as I can, right? Coming to gold now. So gold has crossed 5320 in dollars, right, on 3rd of March. So of course, gold is going to rally because of the uncertainties that is likely to happen, right, in the next few days or weeks, depending on how long this war goes on. But main thing that you need to know is that right now the physical gold is being held up in Dubai because of the flights getting cancelled, as you can read here on my screen, right? That is also likely to introduce a gap in the demand and supply for a short-term period until these flights get restored back. So definitely that is also playing out in terms of the gold prices. If you look at the longer term view, a lot of people, for example, Chris Wood, he made a prediction that gold is going to go $10,000 in the next 5 years. And to be honest, I may not be surprised if actually gold crosses $10,000 in the next 5 years. In particularly, I am very bullish on gold if you talk about 2030 timelines. In the short term, what could happen, I really don't know. Like these situations has happened out of nowhere in the last few months, right? So really you cannot predict gold in the short term, right? It could fall, it could go up. That is likely to be the case. But if you look at the longer term view for gold, it is likely to be very positive. Why do I say that? In fact, I'm going to release a podcast on gold and silver from one of the commodity experts. Very soon it's going to come in the next 1 or 2 days and it's going to be in Hindi. So if you want to listen to that podcast, it's going to come in my Good to Great channel. Again, I forgot to talk about that channel here in the flow. Please go and subscribe to that channel. Hopefully in a day or 2, that podcast will come out. It will give you a lot of clarity on gold and silver from a long-term perspective. Please understand, I do not talk about short-term trades, short-term price movements, because I don't think anybody can predict your short-term moves. But yes, if long-term you are able to think, then I think that's where, in my view, the wealth building will happen. So very positive on gold, and I continue to do my SIPs, right? I started my SIPs last year in gold, and I have been doing them continuously, right? And it's been weekly SIPs doing very well for me. I plan to continue them for my long-term portfolio. Please understand, these are all long-term SIPs that I do. I don't do short-term SIPs, right? So if you have any more questions on this video, let me know in the comments. We'll try and clarify as many as possible. If you have not yet subscribed to channel, then what are you waiting for? Hit that subscribe button. Let me know in the comments. It's simple. Thank you. Like the video as well, because it motivates me to bring such content to you at zero cost. I'm going to see you in my next video. Until then, keep rocking.